Hello, let's look at chapter 15, financial analysis. You're a finance major, you probably love this kind of stuff. Really, this chapter is two parts. You've got the first part that has to do with what's called vertical analysis and horizontal analysis, and also trend analysis, where you're looking at balance sheets and income statements and doing percentages like how much is my net income in relation to sales, what part of my total stockholders' equity, liabilities and stockholders' equity is liabilities, current assets in relation to total assets, things like that. And then the last step is financial ratios, which is like current assets divided by current liabilities, debt to equity ratios, earnings per share, price earnings ratio, and so forth. So let me go ahead and share the screen for chapter 15. We'll go ahead and jump in here. All right, so what you got here is Veriline Corporation. They've got this income statement, and they want you to do some horizontal. Now, that's going left to right. That's horizontal, right? Vertical is up and down. Horizontal, east, west. So we got these revenues, and they just plugged the data here into the table. But first of all, revenues minus cost of goods sold is gross profit. We haven't gotten to that chapter yet in this class. But when we do, you're going to see that revenues minus cost of goods sold is what's called gross profit. And then you've got all your SG&A, selling, general, administrative. So that's $9,950 minus $6,120 is $3,830. You're doing the same thing for each of those 3 years. Then what's unique about this horizontal analysis is you're relating 2019 versus 2018 and 2018 versus 2017. All right, so what have we got going on there? If you take 2018, which is 97.75, where's my calculator? 97.75 for 2018 minus 92.50 is $525. So the base year, when you're looking at 2018, the base year is 2017. So I went up in revenues from 92.50 to 97.75, $525. So 525 divided by 92.50 is 5.7% if you round off. 2019 base year is 2018. So 2019 minus 2018 gives you 175. Again, 175 divided by 97.75 will give you 1.8%. Same thing down here. Base year is 2017, 38.75, so it went up $300. 300 divided by 35.75 is 8.4. And then you've got this one from 2018 to 2019, your gross profit went down. That's why it's a negative 45. But still, negative 45 divided by 38.75 gives you a negative 1.2. All right, so that's number one. Number two, here we got a balance sheet, and they're wanting to do a vertical analysis. That's what it says there, vertical analysis. Not horizontal like we just did, this is vertical. So cash and receivables in relation to total assets is 27%. Merchandise inventory divided by total assets is 20.3. Of course, total assets divided by total assets is 100. You did the same thing for 2017, but this is all north and south, vertical. All right, number three. All right, here's some ratios they want you to calculate. Current assets divided by current liabilities. That is a very basic solvency calculation that many companies look at first. They want to know how many current assets do I have, how many current liabilities, because ultimately the current liabilities are going to have to be paid in cash. And so you better have enough current assets that are going to be turned into cash, whether it's cash, accounts receivable, or inventory, in order to satisfy that debt. So you need to have a current ratio of at least a 1, right? So how do we do this? Well, we're going to look at the balance sheet. The balance sheet for current assets, 52.4, in fact, it calculates it for you. All your current assets, 52.4, 30,600 for 2017. And if we go here and look at the liabilities, my current liabilities are 25,000 and 12,800. And so that gives us our calculation. Very straightforward. what to say here about making a determination. Has the current ratio gotten better or worse? Gotten worse. The lower the number, the worse. If it's less than a 1, that means you don't have enough current assets to pay your debt. The higher the current ratio, the better. It means I got more current assets than I got current liabilities. All right, number 4. Here we want to do a debt to equity ratio. Debt to equity, so what is debt? Debt is total liabilities, not current liabilities, total liabilities. Debt is total debt to equity. Debt divided by stockholders' equity, or excuse me, debt divided by total assets. Well, excuse me. Debt ratio is debt divided, or liabilities divided by assets. Debt to equity is debt, same numerator, divided by total equity. All right, so my balance sheet there, I can't get all this on one page, I don't think. $38,400 for total liabilities. There it is for 2018. And then my total assets, there's my $81,500 for 2018. And then total equity for 2018, $43,100. You can see from that how to plug that in to get your percentages. Is Triumph's ability to pay its liabilities strong or is it weak? It appears to be strong since the debt ratio is fairly low, right? My total liabilities of all my assets that I possess, because that's what assets equals liabilities plus equity. Of all of my assets that I have, that I possess, I owe about half of that, 47%. So think of it in terms of a house. If you have a $100,000 house and you've got equity of $50,000 in it, which is pretty good, right? You just owe half of it. That's pretty good. Same way with the car. Think of it in terms of that. And then liabilities divided by equity and debt to equity. That's not used quite as much as debt to or debt ratio is. All right, number 5. Here we got several things that we're looking at. It looks like primarily the income statement. Again, it's sort of like your vertical analysis. It is vertical analysis. 12,004 divided by what? 41,000 says I've got a 30% profit margin. It's pretty good. And that's not gross profit. That's profit margin after all your expenses. All right, and then we have what's the rate of return on total assets? Well, we're going to take net income, 12,004, plus our interest expense. We're adding that back. That's just what you do for return on total assets. And then my average total assets, we've got to take 2 years worth, don't we? I got to take 86,600 plus 53,200. If I take those two, add them together and divide by 2 to get an average, that should give me 69,900. And so that says my rate of return on total assets is 18.7%. Requirement 3 says, what is my asset turnover? So there's my sales. We've already looked up at my average total assets. But we're using numbers we already looked up. 0.59 means you're turning over your assets in order to drive revenue. I mean, that's why you have assets, to drive revenue. That's why you invest in property, plant, and equipment and intangibles. Those assets drive your revenue stream. What's the return on common stockholders' equity? It's always net income minus preferred dividends. Common stockholders' equity says it's all of my equity minus anything that says preferred. Preferred stock or at par, and preferred stock additional paid in capital. So it's all of your stockholders' equity minus anything that says preferred. It includes retained earnings. It includes treasury stock. It includes all of that. So my average common stockholders' equity is 38,400. So let's click on that. How do we get that? All right, so there is no preferred, so that makes it easy. So if you take 49,000 and 27,800, if you add those two together and divide by 2, you're going to get 38,400. Strong, considering average companies present much lower rates of return, because they give you that here. Industry average for each of these. I mean, the higher the profit margin, the better. Asset turnover, the better. Return on equity, the higher, the better. Strong company. Number 6, earnings per share. You know, we just did return on common stockholders' equity in that previous problem. You always subtract out preferred dividends. And then you divide that by common shares outstanding. Not authorized, not issued, outstanding. And you got to do an average. So let's see here. Is that on my chart? I don't think it tells us how many shares, does it? Must be up here somewhere. There it is. Lowe's has 15,000 common shares outstanding during the year. So you didn't have to calculate like beginning of the year and end of the year, add the two together and divide by 2. They tell you that the average, weighted average is 15. So my earnings per share is 50 cents. So what's my PE ratio? Price earnings multiple. Well, it's going to be my market price of the stock divided by this earnings per share. And there you have it. 1750 is given, divided by 50 cents. My PE ratio is 35. Is that good or bad? Sounds kind of high. The average S&P 500 PE ratio currently is about a 25 or a 26. Maybe even higher, considering we're going through somewhat of a recession. But 35 tends to be high. I mean, some of your growth companies like Netflix are going to be up in the hundreds because it's being priced in on what the future holds. Your General Motors or Ford are going to be in the single digits as far as a PE ratio because they just aren't growth companies. Tesla would be a very high PE ratio. All right, and then number 3, I just talk about what I just talked about, so you can read that for yourself. All right, so that is practice set 1. Once again, it stops my screen share. Let me find practice set 2. I think you can see that. Let me make sure. All right, practice set 2. Only 3 exercises. So here it looks like we got a vertical analysis, right? You can tell it's vertical because it's going up and down for an income statement. And so they're just showing you the income statement there. They just copied that over, this first column. They also give you the industry average. We'll look at that here in a second, I think. But first of all, you just need to do 89,585 divided by 779 is 11.5. 4674 divided by 779,000 is 0.6. And going all the way up to 779 divided by 779 is 1 or 100%. All right, so if you're going to do the balance sheet as well for assets, everything's in relation to a denominator of total assets. And they've got liabilities as well. When you do the liabilities and equity side, again, it's still based on the 440 because it's based on liabilities and equity. So 203,720 is divided by 440. Don't make that mistake. I think it is 304. It's not. It's in relation to total liabilities and equity. You can read the bottom part there and see how that, gain an understanding of that. Number 2, here you got some ratios, current ratio. You already know what those are, earnings per share. And there's the current ratios. It starts out. Oh, I remember this one. So here they're going to have several things that happen, and they want you to calculate it. View the transactions. All right, so what's happened here is under A, they purchased merchandise inventory 43,000 on account. So how does that change these ratios, right? So the first one is, let me get my pad here. This might need a little bit more instruction. Merchandise inventory. So what's happened there? Well, let me add these up first. We got what? Cash, accounts receivable, merchandise inventory. Add those three up. That's my current assets. 19 plus 82 plus 186, right? Those first three here are all current assets. So that is 287,000. Then my current liabilities are 101, 38, and 46. So that's 139 plus 46,000. So my current liabilities are 185. So 287 divided by 185 is 1.55, and that's what we have there, right? They gave that to you. All right, the debt ratio is going to be, well, my current liabilities, which are 185 plus 225. So my total liabilities are 410,000. And my total assets, that's tricky there. Total assets 637. So that encompasses all this that we just had in. So 637 is my I got that reversed. Your assets go on the bottom, the 410 goes on top. Sorry about that. So 410 divided by 637 is 0.64. Yep. And then earnings per share is net income divided by 10,000 shares outstanding. 710, right? 71,000 divided by 10. All right, so now we've got these transactions, and we got to see what does that do to my current ratio. All right? This is what I'm starting with. You can see that. Start with those three ratios, and then you're going to build on that. So I've got $43,000 on account. And so what happens on account? That means we purchase it. So my cash or my inventory went up 43,000, but my payables went up 43,000. So I'm adding 43,000 to both the numerator and the denominator on that 287, right? 287 plus 43,000 is 330,000. And my 185,000 plus 43,000 is now 228. So 330 divided by 228 is 1.45, right? 330,000 divided by 228,000. All we did was added 43,000 to the current ratio on the top and on the bottom. What about my debt ratio? Debt ratio, which is my assets to liabilities. Assets divided by liabilities. We know it's 410,000 divided by 637,000. So we're going to add 43,000 to the top, aren't we? And we're going to add 43,000 to the bottom. So that's going to change a little bit too. So 410 plus 43, so that's 453 divided by 680. Leaving out the thousands, is 67 cents or 67.67 ratio. Okay, what does that do to earnings per share? Nothing. Earnings per share stays the same. All right. What about the next one there? Borrowed 122,000 on a long-term note payable. borrow 100. So what's happened to my numerator there? I've got 122,000 in cash, and you ignore the 43, you ignore what happened in that A, because we're back to square one. We're going to add 122,000 to the 287 for my assets, but then the denominator, current liabilities, don't change. That's a long-term liability. So for part B, under current ratio, it's going to be 287, leaving out the thousands, plus 122 divided by 185 is 2.21. All right. And then the the asset divided by liabilities, the debt ratio, I'm going to add, again, that 122,000 to the 410,000. And I'm also going to add that 122 to the 637, which makes that 760. And that is 0.7. And again, no impact on your earnings per share. Then we go to C, issued 1,000 shares of common stock, receiving a cash of 106,000. All right, so we got cash of 106,000. So I'm going to add that to my 287 again, 287,000. Plus 106, and I'm going to divide that by 185,000, and that is, I did something wrong because my numbers messed up. 287 plus 106 divided by 185 is $2.12. My assets divided by liabilities, there's no impact on the denominator, so that's still 185,000, but my numerator is going to be what? 287 plus my 122, 287 plus 287 plus my 106, 393,000 divided by 185 is $2.12. I just said that, didn't I? Yeah, I did. 410,000. This is for my second one there, the 55 cents. 410,000 plus 106 gives me a numerator of 516 divided by 637 is 81. Oops, I did something wrong. What did I do wrong? Issued 1,000 shares of common stock, receiving 106,000 in cash. 410 plus 106 divided by 637 . 410 plus 106 divided by 637. 0.81. What am I doing wrong on that? Issued 1,000 shares of common stock, receiving cash. Well, I know it's something stupid. Oh, that's right. I flipped it. It's 410 divided by 637 plus 106. Debt is on top. Good grief. All right. You see that there's 637 plus 106. I was adding the 106 to the 410. All right. So 410 is my debt, and my asset is 637 plus 106, 0.55. All right. And then the earnings per share, 71,000 divided by 10,000 plus the 1,000 shares, $6.45. Earnings per share didn't, or the earnings didn't change, net income. Number of shares did. And then the last one is receive cash on account for 8,000. So we're just adding 8,000. Maybe I'll just do that. That's easier to read anyway, isn't it? 287 divided by 185. Nothing changed. Because it says receive cash on account. So that means that accounts receivable changed. Accounts receivable went down and cash went up. So there's no impact on your current assets, is there? All right. And there's no impact on your debt ratio. So it's the original 64.64, and there's no impact on your earnings per share. All right. So you can see the solution there. Make sure you get your ratio right. I completely flipped it there on that number 3 or C. All right. Trying to get in a hurry. So that's 2. I think that was all. And then number 3. Here we got a trend analysis. What's different about a trend analysis versus horizontal analysis? A trend analysis is you're going to use 2016, since that's the oldest year, that's going to be your base. The horizontal analysis you saw where the base changed each year because it's year over year. With trend analysis, everything is based on 2016. What's 2017 compared to 2016? It's 97%. 642 divided by 659 is 97. What's 709 divided by 659? 108, 1.08. What's 759 divided by 659? 115. So you're using base year for each of these is 2016. That's the difference between trend analysis and horizontal analysis. And then return on common stockholders' equity. Net income, 31, 36, 64. And the average common stockholders' equity. That's the ending. Where's the beginning? There it is. So you got to use what they give you there along with what's in this table. So for 2017, I guess is the first one we're looking at. Yep. You need to take 324 that's the same numbers, 324, 350. Oh, I've seen now. Good grief. Long day. So what you got to do for 2017 is I've got 324 and 306. So what's the average of 324 and 306? 315. What's the average of 324 and 350? 337. What's the average of 360 and 350? 355. So that's where you get your averages. Not sure what I was thinking. And that gives you your percentages. All right, got one more here. Self-assessment. Only one. Common size statements. Looking at the industry average. So 783 divided by 783 is 100. 527 divided by 783 is 67.4. 85, 347 divided by 783 is 10.9. And so then you plug in the industry average and then you can compare. This says my cost of goods sold is a little higher than the average, which means my gross profit's a little lower, isn't it? my margins are a little lower. Same thing here under a common sized balance sheet. Again, everything is related to total assets. So 310 divided by 460 is 67.4. 119,600 divided by 460 is 26. And so then you plug in the industry average, and it says my current assets are a little lower than the industry average, whatever industry I'm in, and whether it's manufacturing batteries or automobiles, cell phones, peer averages are very important. And then you can calculate gross profit percentages and so forth. That's already up there. Current assets, current liabilities. There's gross profit, net sales, net income, net sales. Already calculated for you. Net exercise. Total asset or current assets divided by current liabilities. Liabilities divided by equity. All right, so there you have chapter 15 very quickly. Hope you have learned from this video, and we will talk again soon.